Hi, everyone. Thursday, December 15th. Welcome to Three Things with Spyglass Lending, where we delve a little bit deeper into the mortgage and real estate related industries. As I like to say, not your usual rigmarole, not the attention grabbing headlines out there that don't tell you much. We got to get behind the scenes and see what's really going on. This is an interesting week to do it, certainly, because two major things have happened. Number one, on Tuesday, the inflation report came out, and hey, it seemed to be good news, right? We were over 8% for quite some time, and all of a sudden there was a pretty big drop. Still over 7% ultimately overall for the real cost of goods, but for the most part, a pretty sizable drop. This was good news. Everybody was expecting to see inflation ease up a little bit as we head into 2023, as we head especially into the holiday season, and it did, and that's obviously good news. And then the following day, the Federal Reserve came out and raised rates yet again, but we knew this was happening. It was baked in, and after four straight of pretty sizable height rates, they actually eased up a little bit, and this was a little bit less. But again, what was seemingly good news, we have to question, is this good news as we head towards the end of this year and certainly into next? Well, let's take a little bit deeper look. Let's start with what the Federal Reserve has done here. And it's worth going back and looking at the rate hikes for the year. It's important to kind of see us in front of us, and because we know as they happen, it's like, oh, they raised the rates again, and everybody gets an idea of what that means. But let's start, first of all, what it means. What is it exactly that they're raising? You can see on column 3, it's the federal funds rate. Well, this is the rate essentially that commercial banks both borrow and lend their excess reserves. And what that means is it has an effect directly on lines of credit, personal lines of credit, home equity lines of credit, car loans, and certainly credit cards, and more of an indirect effect on mortgages. Everybody thinks that if the Federal Reserve raises the rates, it automatically just raises mortgage rates. Not so, but it does have an indirect effect, and usually that happens. Okay, but you can see they started in March 17th of 2022. They raised it, and you can see how low the federal funds rate is. Exactly, basically, it was nothing for a long time, a quarter, and then it jumped to 50%. And the jump, as you can see, was 25 BPS. That's what it's known as. And that really wasn't sizable. But at the time, everybody should have gotten an idea, we are now raising. After a long time of not having to raise, all of a sudden we are raising. Everybody expected this. And we talked about that there were going to be 6 raises throughout the year. But it's a big thing talking about it and then actually seeing it in action. Because the next one they did, well, a little bit bigger. It was 50 BPS as inflation was heating up through May. And then June, as we know, the bottom really dropped out. We said, we are firmly entrenched in over 8% inflation. We've got to get aggressive. 75 BPS, 75 BPS. This happened 4 times in a row until finally, just this last one here in December, it is 50 BPS. Inflation cooled off a little bit, as we know. They don't have to get as aggressive, but still, we are getting aggressive. And they're talking about into 2023 raising them again. So we might see 50 BPS raises. We might see a quarter raises. But again, the bottom line is we are still raising. So the question is why? Why are we still raising if inflation is cooling? Because it gets you an idea of what inflation does. This is a really good graphic because it gives you an idea of the effect, the direct effect that inflation has. Cost of goods. Well, start with a cup of coffee. For the most part, most of the country is drinking it every day. And it gives you a really good idea. Now, I'm going to start all the way at the end there and say $1.85 for a cup of coffee. Most of us are paying a lot more than that, as we know, but it depends where you're buying it and what you're putting in it, certainly. But for the most part, on average, a cup of coffee really does cost less than $2 in a lot of places. But going back to 1970, when it was a quarter, you can kind of see, and this is mostly what's most important about this chart, what you're jumping per decade, right? So between 70 and 80, it was a 20-cent jump. Between 80 and 90, which is actually sizable and it felt sizable at the time, it was a 30-cent jump. But between 90 and 2000 and 2000 and 2010, you're only seeing a quarter jump, right? Literally 25 cents in jump in inflation in the cost of goods. But then all of a sudden, now between 2010 and 2022, it's a 60-cent jump. That's big. That's sizable. That's worth noting. That's understanding what it is we're all feeling here. A cup of coffee, a gallon of milk, the food on the table, and obviously what we're paying for mortgages. But more importantly, not necessarily what we're paying for the mortgage itself, the money itself, right? Because everybody's up in arms now that we've jumped all the way up to 6% or 7% money. The reality is that's not out of line. What was out of line is actually having the money sub 3% like it was through the pandemic. because it was essentially free and everybody took advantage of that. And what did it do? It drove everything up. It caused the inflation. It caused the cost of housing to be as it is right now. And the question is this going to be sustainable? Not only the cost of goods, but the cost of housing. Now that the mortgage rates, which again have settled back down because this has all been baked in. It's no longer over 7%. We've settled into this 6% pocket. But the question is it going to remain there? Is it going to go down, or is it going to go up? Unfortunately, the answer is it very well could go up. And the last idea is why. Again, here's the attention-grabbing headline you see all the time. Retail sales, manufacturing declines point to a slowing economy. So what does that mean? Well, if you look at November, which everybody likes to point to, why? Because we're heading into holiday season. We're talking about over the Thanksgiving area. We're talking about Black Friday, Cyber Monday. Retail sales slowed. And that's a big thing. If you're looking and saying, even though it was 0.6%, you're looking at this and saying consumers are not spending as much as we head into the holiday season because of what inflation has done to them, or because of their fears of recession as we head into the next year, you've got to think about that. And you've got to think about how the recession will affect if and when it comes heading into 2023, and what it does certainly to the markets. Look at what's going on today. Again, December 15th. Go look for yourself where the Dow and the NASDAQ and the S&P are today. They are all down, and down sizably, because this is the report. Way more than the inflation report, way more than the what the Federal Reserve had done and their interest rate hike, is the notion of retail sales being down. But of course, what the Federal Reserve has done and where inflation is at has an effect on those retail sales. So we all have to be cautious about moving into that recession next year. It's more than likely. Again, it's not necessarily going to happen, but it's more than likely that it will. And these are the reasons why. And unfortunately, you're probably going to still see a slowdown in most housing for those that are way out of line on the pricing. And you may still see the interest rates have to rise next year to match that and keep that coming down. So whether it happens or not, keep your head on a swivel. Appreciate you joining me on 3 Things with Spyglass Lending. We'll do it all again next week, next Thursday. Thank you.